Robschild. No investment advice. Welcome to the show where we view financial markets using technicals, macro, Benjamin Graham's investment philosophy, and of course, crystal ball gazing. Today is Tuesday, October 1st, 2024, the first day of quarter 4, 2024. Today's episode, we will start discussing a little bit about the tension in the Middle East, how that's affecting markets, and the narratives going on. I want to start with a headline from yesterday before the escalations in the Middle East. We had a headline on Yahoo Finance saying, this week's economic data could be hugely bullish for stocks. I'm going to save this screenshot with the date just to see how well it ages. If you've been following the show, you know I'm not very bullish myself, so I'm very curious how this will play out. Escalation in the Middle East, says the market. Well, better put my money into American military equipment stocks like Lockheed Martin, jumped almost 4% today on this news. Normally, if we're thinking about any kind of war escalations, actually that's usually good for stocks, and instead we went down by 1% in the S&P 500. Pretty odd. I'm wondering if this narrative is to make people think that the stock market's falling today because of potential escalation in the Middle East, when it's actually smart money dumping. You may, if you watch a lot of finance shows or read a lot of news, you probably came across the fact that a lot of billionaires, a lot of insiders of some of these mega cap companies are dumping a lot of their own shares. Warren Buffett himself has more cash than he's ever had. Some of these, people literally like infinite resources are dumping all their shares. And, we see on Yahoo Finance, the headline for, the small guy, hey, this could be hugely bullish for stocks, everybody. I'm like, I've never been more fearful of stocks right now, but I'm just a guy with a crystal ball. Job openings came out higher than expected. In the last reading of this, we had 7.7 million. That's the last and what was expected for this most recent reading of job openings. Instead, it came out officially higher. There are many indicators suggesting that the economy is about to really slow down hard, but this hasn't hit job openings yet. So we'll see how long it takes for this to follow suit along with all of the other things going on. The most important news of this week that everyone needs to pay attention to is this, the unemployment rate on Friday. This is like the number one indicator of, how good or bad the economy is. If you get to the point where you have 1 out of 10 people wanting a job and they can't get a job or they don't have a job, that's like recession. That's like, oh God, what are they going to do? 10% of the country needs a job to make money to pay for stuff and they can't get a job. That's why this number is so incredibly important. So look out for that Friday. I'm not going to read through the daily reminders. I do that only on Mondays. You can watch yesterday's show if you want me to go through them. Nothing changed today. Again, if anything changes in any of this data, I will give daily updates on it. In a nutshell, everything together has the crystal ball reading saying that there is a market crash incoming. And I believe the Fed will not cut fast enough and is not cutting fast enough to save the economy from really slowing down majorly right now. I mentioned yesterday in the S&P 500 we had an engulfing candle of the past 2 days suggesting bullish movement, but it seems like, at least the narrative is that because of tension in the Middle East, the stock market sold off. Again, usually, any hint of war is actually good for company valuations, and they dropped today. So, is this part of the whole like trying to get the retailer in here and be like, oh yeah, it dropped because of tension in the Middle East today, so buy up, everybody. Meanwhile, insiders are, institutions are dumping into this. I suspect that is what's going on. And then from a chart pattern stance, I did mention how this just looks like it's doing another rollover. Look at these. We have a hill, a hill. This is another hill. Looks like it wants to go down, but especially today, pretty fairly formidable red candle today. TLT, my favorite place to be, is surprising me. It's holding up. It actually, it's looking like it's gaining a little bit of strength here. I thought we were kind of knocking on this door of this to get to more downside, but looks like we are getting some buyers in long Treasury bonds. I'm just above 50% in long Treasury bonds, so I'm very bullish on Treasury bonds. I think that, if the stock market really does correct here, this is the perfect time to have long Treasury bonds. Again, no advice on this channel. From today's action in DXY, the dollar index, it looks like I made a pretty good call yesterday. I called out exactly yesterday. I haven't talked about DXY for a while, but I noted yesterday how we had been coiling up here, and how I've heard pretty much everyone and their cousin talk about how the dollar index is going down to 96. And I said, this looks like it might be even forming a bottom here, and we might be heading up. This was a pretty good crack up when you look at all these candles before building up all this tension and then breaking out to the upside. The most likely direction now is to continue higher in the dollar. Again, this is while rates are dropping, on the front end of the curve and on the back side of the curve, weakening the dollar, and yet the dollar is getting stronger. It makes sense to me from a macro standpoint, mostly because of Benjamin Graham. When you look at valuations of things, from his perspective, or what his perspective would be today, he would definitely say that there is an enormous amount of speculation priced into markets right now. And if that speculation gets pulled out of the market, the dollar will benefit from this. And so, yeah, we'll see how it goes. The high yield corporate spread between the yields you can get on junk bonds, which are below investment grade bonds, notably dropped today, or the most recent update of this, down to 3.03. Oh, it's updated as of yesterday. Yeah. So this is notable. Again, people are chasing yield here, and this is not intelligent investing. Benjamin Graham correctly says junk bonds always go on sale. They always go on sale, and that's the only time it's worth to buy them. Anybody buying junk bonds at full price is, they're taking unnecessary risk for the amount of reward that you can get. In a downturn of a business cycle, these are the companies that have the highest risk of default on their bonds, where they can't pay some of the payments, or they default completely and the whole company gets wiped out. Being only a 3% difference between these and Treasury bonds is very, very tight credit spreads. Back in 2022, the difference got up to around 6% difference. If we scroll out, the worst it got in the financial crisis got all the way up to a 20% credit spread. Once in a blue moon, it drops below a 3% spread, but not very often and not for very long, suggesting that it is very likely for the spread to widen. I mentioned yesterday a bull flag on the VIX. This is the VIX, the options implied volatility chart. We had a bull flag here. I said, well, that's bullish for the VIX. And yeah, it was a little bit of a black swan event with the tensions rising in the Middle East, we'll say. But yeah, it went higher as I was expecting it to from a chart standpoint. Without those tensions rising, it'd be interesting to see what would be happening here. It was a few days ago when we were getting news of this tension escalating in the Middle East, and oil actually was dropping. It wasn't really going up. Finally, we have a up day in oil, but it's not like even a massive up day. We're still strongly in a downtrend in the price of oil. So Again, it's amazing. How my question is, how low would oil be if there was no tension in the Middle East right now? Think about that. There's literally oil shock risks going on right now, and oil is just, it's been going down, and it's not showing any signs of really any major strength. You could argue we have a higher low from this bottom here, but it's not like, this isn't like a major break higher. We don't have a higher high yet. If you count this as the higher high, a low, a high. We need a higher low. What about the higher high? We don't even have that yet, but I'll keep an eye on it. The NASDAQ, or the triple Qs, had a pretty big crack to the downside, suggesting that, again, head and shoulders, shoulder, head, shoulder, this head and shoulders still appears to be in play. I think we might get down to this neckline and break it. I mentioned yesterday I got a lot of extremely cheap, extremely out of the money, extremely soon expiration date calls on KWeb at 49 for Friday. In all honesty, it's not that likely to get to 49, but if it does with contracts that cheap, why not take a swing at it? Now, because I bought those contracts, I tried looking at the Hang Seng market, which is supposed to open 9 p.m. Eastern Daylight Savings Time, and it wasn't moving. I'm like, what was going on? I had to use ChatGPT trying to figure it out. They have a holiday apparently today. The markets were closed in China. So, we have, this is KWeb. So none of today's bullish movement to the upside included any Chinese investors, all while they're supposedly climbing over each other to get into this market here. Again, I'm extremely bullish this market. And it's largely, again, a Benjamin Graham thing. The valuation is clearly suppressed. This isn't a balloon of helium expanding to the limits of the sky like the S&P 500 at a PE ratio of 30 waiting to burst. This is a balloon that's been held underwater, just being held underwater, waiting for someone to let go. And it's gotten, the way I see it, someone let it go, and now it can float to the surface. And the surface, to me, in KWeb specifically, is around the $50 range. While you might hear some people saying that this could be a quick short opportunity, I would not try to go short this with a 50-foot pole. I think this could, believe it or not, accelerate to the upside. The kind of mania for buying stocks that you saw before the Great Crash in 1929 is very different than this. In 1929, there was a little bit too much confidence in the valuations of too many things, and it was mania. This is not mania. This is a balloon being held underwater and being finally let go. And so the rise to the surface, I think, will put a lot of people off guard, and I think it will blow up a lot of hedge funds. I read some articles. There's a lot of shorting entities that are it sound like they're in trouble right now over this. Bitcoin is continuing to be interesting. Again, this has become sort of a good leading indicator as far as, are we in a risk on or risk off mode? Are people in Bitcoin chasing new highs, or are people selling these risky assets in fear of, let's say, de-escalation of speculation? As it stands, it looks a little bit like three black crows here. To my eye, it looks like there's a good chance we may head back down to the $50,000 range. Crypto, total market cap excluding Bitcoin, also showing weakness. Money is flowing out of crypto back home to the US dollar. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.